Monday, October 20th, 2025. Welcome to the Noticias El Salvador SV podcast, a space for conversation and reflection where we explore current topics from El Salvador and the world together.
You can contribute your financial support via PayPal or via Bitcoin QR. You will find the PayPal link in the content description and the Bitcoin QR code on the cover of this episode.
When you send a payment, please include the reason for the payment in the subject line, something like collaboration, I like the topics you discuss, to buy a coffee, contribution for your podcast. This is for internal control purposes.
Yeah.
Also, remember, you can advertise through this space.
That's right. If you are interested, the email address is in the description. Write to us. We will be very happy to hear from you.
And remember to look for us on your favorite platform, on Spotify, Pandora, Apple Podcasts. We are on almost all of them as Noticias El Salvador SV.
Okay.
So let's unpack this. That's the mandatory stuff out of the way. Our mission today, as always, is the deep dive.
Exactly. And we've got quite a bit to cover. Huge geopolitical shifts, some really critical stuff happening in El Salvador, and, well, the crypto markets are lively.
Lively is one word for it. Yeah, we're going to try and distill everything from the last, 72 hours? Saturday through today, Monday, October 20th, give you the context, the key details.
And what it all might actually mean.
Right. So let's start internationally. Big picture first. There have been some major power shifts and some high-profile drama.
Definitely. The global stage has seen some pretty significant moves. We're talking potential ends to long political cycles, major foreign policy changes. It sets the stage for a lot, including what we'll discuss later with the markets.
Okay, first stop, South America, Bolivia. This seems like the biggest political news today, October 20th. Rodrigo Paz winning the presidency.
Yeah, that's huge. It basically ends almost 2 decades of left-wing governance there. It's not just changing the person in charge, it signals a potential ideological pivot for the whole country.
20 years is a long time. That kind of governance gets embedded pretty deep, doesn't it?
Oh, absolutely. Institutions, economic policies, trade deals, social programs, how they manage resources, everything. Paz's victory is a really decisive break.
And it'll have ripple effects regionally.
For sure. Think about bodies like Mercosur, relationships with Venezuela, Cuba. This changes the dynamics.
Yeah.
And then there's the economic side, especially with resources.
Lithium. Bolivia has tons of it.
Exactly. A new, maybe more market-friendly government under Paz. That could completely change how they manage, extract, and sell that lithium internationally.
Which could impact the global EV market supply chain.
It absolutely could. The previous government often favored state control or very tight partnerships. A pro-market approach might attract a lot more international investment, faster access.
So more competition, potentially lower prices down the line.
Potentially. Or just shifting who gets access. It definitely resets the power balance in South American resource politics. It's a long-term thing starting right now.
Okay, let's shift north. United States foreign policy. President Donald Trump made a big announcement on October 19th, ending financial aid to Colombia.
Yeah, and the language was pretty sharp. He specifically said Colombia is fostering drug production. That's a really strong accusation between nations.
Historically, that U.S. aid was pretty critical for Colombia, wasn't it? For anti-drug efforts, development.
Critical is the right word. Cutting it isn't just pulling money. It feels like pulling diplomatic support. A massive shift.
So what happens on the ground? The programs that relied on that funding.
That's the million-dollar question, isn't it? Does it create instability? Does it push Colombia to look elsewhere for partners?
Which could complicate things for the U.S. and the region even more.
Exactly. The gamble is that withdrawing aid forces Colombia to change course fast. But the risk is it backfires, creates a vacuum, maybe even makes the drug problem worse if security funding dries up. And it definitely strains the relationship. Very high stakes.
Okay, moving from high-stakes policy to, high-stakes drama, Paris. The Louvre Museum closed today, October 20th.
Yeah, because of a jewelry robbery. And not just any robbery, you're sort of calling it spectacular, like something worthy of James Bond.
Wow, that implies some serious planning, sophistication.
Definitely not your average smash and grab.
Yeah.
Suggests they knew the systems, maybe had inside knowledge, high-tech tools, the works. Closing the Louvre itself is huge news.
And the security implications. If the Louvre can be hit like that, every major museum, bank, secure facility everywhere must be reviewing their protocols right now.
Absolutely. It's a major wake-up call for the entire security industry. And think about the impact on tourism, even temporarily. It erodes trust. The investigation will be massive globally.
Before we move on from the international scene, there was a mention, an editorial note, about something slightly older but still relevant from October 13th, a hopeful peace agreement in the Middle East.
Right, that referred to the news about Hamas releasing the last live hostages from Gaza and Israel freeing nearly 2,000 Palestinian prisoners.
Amidst all the turmoil, that was a significant development.
It was a huge prisoner and hostage exchange. It showed that even in the most difficult, deeply rooted conflicts, negotiation can achieve something tangible, some relief. It's a reminder that de-escalation, however hard, isn't impossible.
Okay, let's bring the focus closer to home now. El Salvador. While the world deals with these big shifts, El Salvador seems laser-focused domestically, and security gains seem to be boosting confidence.
That's the narrative, yeah. And the headline stat today, October 20th, supports it. The weekend closed with 0 homicides.
Which, for El Salvador, given its history, is incredibly significant.
Immense. It's a measurable change in daily life, in perceived safety. It shows the current security strategy is having a real impact, consistently achieving these homicide-free periods.
And they're not stopping there. They're planning for 2026 already.
Looks like it. The focus is on tech upgrades, better infrastructure, more mobility. So it's not just about boots on the ground. It's about modernizing the security apparatus for the long haul.
Treating the current success as a baseline to build on.
Exactly. And this sustained security focus seems to be directly fueling economic confidence. The big number, also from today, October 20th. Credits in the financial system have topped $20 billion, a record.
$20 billion? That's enormous for El Salvador's economy. Where's that confidence coming from? Is it foreign money pouring in, or?
The analysis suggests it's primarily domestic. Households, businesses, productive sectors. They're the ones borrowing.
So local people and companies feel secure enough about the future to take on that much debt?
Apparently so. When everyday people and businesses borrow at that scale, it signals real confidence and stability, both now and in the near future. It often points to strong domestic consumption, maybe helped by remittances, and possibly financing for public works. It definitely makes El Salvador stand out financially in Central America right now.
But it's not all positive news. There are some serious long-term clouds on the horizon mentioned in the reports. Demographics, for one.
Yeah, that's a big one. Projections say El Salvador's population will peak in about 14 years, around 2039, and then start to decline.
Like we see in Japan or parts of Europe?
Similar trend, and it has huge implications down the road. Pensions, the workforce size, GDP growth. Planning needs to start now for an older, smaller population eventually.
And environmentally. This report from the UES about Lake Guja sounds really bad.
It's deeply concerning. The University of El Salvador found 4 specific heavy metals, not just in the water, but in the fish.
In the fish. That means it's in the food chain.
Exactly. That turns it from an environmental issue into a direct public health crisis. Heavy metals build up in the body. Lake Guja is shared with Guatemala. It's internationally important. Finding these metals suggests serious pollution, probably unregulated runoff from industry, maybe mining or intensive farming.
A long-term contamination crisis needing immediate action.
And bilateral action in Guatemala. Plus, testing people who rely on the lake for water and food. This is a major red flag raised by UES.
Okay, and speaking of public health, this is where things get really alarming. The situation with hospital-acquired infections, HAIs, at the Seguro Social.
Yeah, this is stark. The reports detail a shocking rise in deaths from these infections contracted within the main public health network.
How bad is it?
The numbers are frightening. 113 deaths attributed to HAIs in 2024 so far. Compare that to 78 in all of 2023. That's a 45% increase.
45%. That's not just a blip. That sounds systemic.
It strongly suggests a breakdown. And the workers' union, Symmetris, is sounding the alarm too. They're specifically warning about a high incidence of superbuzz, drug-resistant bacteria in the facilities.
So you go in for care, and you risk catching something potentially deadly that antibiotics can't easily treat.
That's the terrifying reality highlighted here. A 45% jump points to potentially overcrowded hospitals, maybe inadequate sanitation, maybe not enough resources to isolate patients with these resistant bugs. It's a massive blow to public trust in the healthcare system.
Okay, let's shift gears slightly to judicial matters. The government's legal cases continue. Catalina Miranda, the transport businessman, still in the news.
Still facing that long sentence, yeah. 12,272 days for 5 crimes. His case goes back to 2022 when he unilaterally hiked bus fares.
I remember that. Big controversy.
Huge. So his ongoing imprisonment is framed as a symbol of the government cracking down on perceived price gouging, protecting consumers. Keeping his name out there reinforces that message.
And another name from the past resurfacing, ex-FMLN deputy Shafik Handel. Court order for his capture.
Yes, and they've requested a red notice from Interpol. That means they're looking for him internationally. It continues that pattern of judicial action against figures from the former ruling party, the FMLN.
But alongside these high-profile cases, there are some deeply troubling reports about, well, basic human rights and the fate of deportees.
This is heartbreaking stuff. Families are reporting that 6 Salvadorans deported for the United States have essentially disappeared. Authorities apparently aren't providing any information on where they are.
Disappeared after deportation. What does that mean?
It means agonizing uncertainty for the families. They don't know if they're in detention, if something worse has happened. The report mentions one young man, Irvin, 24, deported back in March. His family actually moved back to El Salvador after 9 years in the U.S. just to try and find him in the system. That tells you everything about the lack of information.
And this lack of accountability, or worse, seems echoed in another tragic story. Professor Manuel Mira dying just 22 days after being released from prison.
Yes, and his family alleges maltrial mistreatment during his detention. The fact that he's the second teacher reported to have died shortly after release in just 2 months, it raises serious questions.
Questions about conditions inside the penal centers. Overcrowding, negligence, abuse.
Exactly. Allegations of mistreatment followed so quickly by death, it demands investigation. These stories, the missing deportees, the deaths post-release, point to potentially severe systemic problems within the detention and judicial system that need urgent attention and transparency.
Okay. A lot to process there on the national front. Let's make a sharp turn now into the world of global finance, specifically the crypto markets. They're definitely buzzing to start the week, October 20th.
Oh yeah. Bitcoin, in particular, after a shaky end to last week, it mounted a pretty strong rally over the weekend, blew past $111,000. When we checked, it was hovering right around $111,019.
So the bulls are fighting back.
Seems like it. Shows some resilience, but it's still a very tense, very leveraged environment.
So with this rally, what are the traders looking at now? What are the immediate targets?
Well, one trader, Crypto, he's focused on a specific technical setup, a big cluster of short liquidations sitting between $116,000 and $117,000. He calls them upward imbalances.
Okay, break that down. Short liquidation cluster. Why does it act like a target?
Right, so you have traders betting the price will go down. Those are the shorts. They use leverage. If the price goes up instead to a certain point, that 116K to 117K zone, a whole bunch of those short positions get automatically closed out. They're forced to buy back Bitcoin to cover their losses.
Which creates sudden buying pressure.
Massive buying pressure. It's called a short squeeze. It pushes the price even higher, faster. So that zone is where the bears are most vulnerable, and the bulls could see a quick win. It acts like a magnet for price.
Interesting. That's pure market mechanics. But another analyst, Ted Pillows, he's looking at $112,000 as a key level, linking it more to macro factors.
Yeah, Pillows sees holding 112K as a sign the market's recovering its confidence. And he connects that optimism partly to reports of easing trade tensions between the U.S. and China.
Ah, the broader risk appetite.
Exactly. Crypto doesn't exist in a vacuum. When big global risks seem to lessen, like a potential thaw in the trade war, investors feel more comfortable putting money into riskier assets like Bitcoin. So for Pillows, 112K isn't just technical, it's psychological, showing the market's shaking off some of that geopolitical fear.
So we've got bullish targets, some positive macro whispers, but there's always a counter-argument, right? Trader Roman seems persistently bearish.
Roman's definitely waving caution flags. He looks at this rally and sees weakness. His main points are, 1, the volume is low. A big price move on low volume often suggests it doesn't have strong conviction behind it, making it vulnerable to reversal.
Like it's easier to push the price up when fewer people are participating.
Kind of.
Yeah.
And 2, he's seeing bearish divergence on indicators like the RSI. That means momentum might be weakening even as the price is ticking up. That's often a classic warning sign before a drop.
But his big obsession seems to be that $102,000 wick. Explain that. What's a wick and why is it so important to him?
Okay, so on a price chart, a candlestick shows the open, high, low, and close for a period. A wick is the thin line showing the extreme high or low reach during that time. On October 10th, Bitcoin's price briefly crashed way down to $102,000 on the Binance exchange, then snapped right back up. That left a long, lower wick.
And Roman thinks the price has to go back down there.
He and many technical traders believe these unfilled wicks or gaps represent unfinished business, market inefficiency. They feel the market has a kind of psychological pull to revisit that level, to fill the wick, before it can make a truly sustainable move higher. So that 102K level hangs over the market as a potential target for bears.
So it's a real tug of war, momentum pushing up towards 116K, but the memory of that 102K low pulling down.
Precisely. Holding above 111K is positive for now, but that 102K risk is definitely something traders are watching closely.
And speaking of risks, the macro picture this week is unusual. The United States Consumer Price Index, CPI, is coming out Friday.
Yes, and that's the really strange part. The U.S. government is mostly shut down, right? Most data releases are delayed.
So how is CPI getting released?
It seems the Bureau of Labor Statistics, BLS, which puts out CPI, has managed to keep operating, perhaps due to specific funding or being deemed essential. Whatever the reason, it means this one piece of inflation data is coming out, making it incredibly important.
Especially given the timing. The Fed meeting is just days later.
Exactly. The Fed meets on October 29th, just 5 days after the CPI release. This report will be basically the last, and maybe only, major inflation data point they have before making their interest rate decision.
And the market thinks it knows what the Fed will do.
The market is heavily leaning towards actually pricing in a 0.25% rate cut. You can see that in tools tracking probabilities.
Okay, so connect the dots for Bitcoin. What does the CPI number mean for risk assets?
It's pretty straightforward. If CPI comes in lower than expected, meaning inflation is cooling faster, it reinforces the case for that rate cut. Rate cuts tend to weaken the dollar, increase liquidity, and generally boost assets like Bitcoin. Big tailwind.
And if CPI is higher than expected,
then it throws a wrench in the works. Hot inflation could make the Fed rethink that cut, maybe hold rates steady, or even hint at future hikes. That would likely hit risk assets hard, potentially wiping out this week's gains. So Friday's number is crucial.
Plus, we still have the background noise of geopolitics, right? President Trump and China trade talk.
Always. The market is super sensitive to any comments from Trump on the trade war status. We saw earlier how reports of easing tensions help sentiment. Any negative turn there could sour things fast. It keeps that overall sense of fear simmering, which is why the crypto fear and greed index is still stuck down at 29, in fear.
And what about leverage in the market? We saw that big liquidation cascade on October 10th. Are traders jumping back in?
They are, but cautiously. Analysis from Arab Chain at CryptoQuant shows the leverage ratio is gradually climbing back up, gradually being the key word. Meaning traders aren't going all in with crazy leverage like before the crash, they're being more careful. It suggests they might believe the worst is over, maybe trying to catch that potential move to $116K, but they're not expecting a sudden moonshot.
So some confidence restored, especially with the price holding above $110, but tempered by the macro risks.
Exactly. It confirms $110 seems like a decent floor for now, but acknowledges the CPI, the Fed, and that lingering 102K wick are still major hurdles. It's a cautious optimism, if you will.
Okay, a lot happening there. Before we dig into where the institutional money is flowing and the big Bitcoin versus gold debate.
Right, let's just take a quick pause. We want to remind you, our listener, how you can support what we do here.
Absolutely. These deep dives take a lot of work, and we rely on listener support to keep them going and maintain the quality.
So if you find this valuable, please consider collaborating or donating. You can use PayPal or the Bitcoin QR code.
The PayPal link is in the description, and the Bitcoin QR code is on the episode cover image. Easy to find.
And remember, if you have a business or service you think our audience would be interested in, advertising through this space is also an option.
Definitely. Just reach out via the email in the description. Your support, in whatever form, really does make this possible. Okay. All right, let's get back to the market data. We know retail sentiment is cautious but returning. What about the big players? The institutions using things like ETPs, exchange-traded products. How do they handle the recent volatility? #A's, capital flows, and market dominance.
Well, the institutional picture, according to the CoinShares report by James Butterfield, is pretty complex. They definitely didn't panic as much as maybe some spot traders did, but the money flow did turn negative last week.
Negative. So outflows from crypto ETPs.
Yeah, about $513 million flowed out of crypto ETPs overall last week. That actually broke a 2-week streak where they'd seen huge inflows, like $9.1 billion combined. So institutions had been buying aggressively, But this recent dip caused a significant pullback.
$500 million is quite a bit of caution.
It is. Butterfield notes they held positions better than many on-chain traders, but still, the pressure was enough to see a net exit.
And was that exit mainly from Bitcoin ETPs?
Overwhelmingly. Bitcoin ETPs alone saw $946 million in outflows last week. Almost $1 billion pulled just from Bitcoin products.
Wow. That really tempers the narrative of nonstop institutional adoption of Bitcoin, doesn't it?
It certainly shows it's not a simple one-way street. But here's where it gets really interesting, maybe even contradictory. While nearly $1 billion flowed out of Bitcoin ETPs, Ether ETPs actually saw $205 million in inflows during the same period.
Inflows into Ether ETPs, while Bitcoin ETPs were bleeding.
Exactly. And get this, the bulk of those ETH inflows, $457 million worth, went into a 2x leveraged Ether ETP.
Okay, wait. So institutions pulled nearly $1 billion out of relatively straightforward Bitcoin exposure, but poured money into a leveraged bet on Ether going up.
That's what the data suggests. It looks like a very tactical rotation. Maybe they see Bitcoin as too tied to the broader macro risks right now, inflation, geopolitics, so they reduce exposure there. But simultaneously, they're making aggressive, leveraged bets that Ethereum specifically might outperform in the short term.
Seeking alpha, higher returns outside of Bitcoin itself.
Precisely. They're hunting for yield and volatility in altcoins. That's probably why we also saw inflows into Solana, SOL, and XRP ETPs, optimism about new product launches there, maybe seeing more upside potential compared to Bitcoin right now. Solana's inflows were up 67% week on week.
This rotation away from Bitcoin ETPs and towards altcoins, does it threaten Bitcoin's dominance in the market?
Well, according to analysis from Rect Capital, it might be. He argues that Bitcoin dominance, currently around 59.6%, seems to have lost its long-term uptrend.
Meaning the share of the total crypto market cap held by Bitcoin is stalling or falling.
Exactly. And critically, that 60% level, which used to be strong support for Bitcoin dominance, now looks like it's acting as resistance. It's struggling to get back above it.
So if dominance keeps falling, does that signal the start of a real altcoin season?
Rect Capital thinks so. He's watching the 57.68% level specifically. If Bitcoin dominance breaks below that support, he predicts it could trigger a major sustained run for altcoins.
And we're seeing hints of that already.
Definitely. Look at some individual altcoin moves recently. Bounce, IUCTO, up 60%, Replicaia up 22%, Synthetics, SNX, up almost 20%. The money leaving BTC ETPs seems to be finding a home in these kinds of plays.
Okay, so all this market churn, the flows between Bitcoin and alts, it inevitably brings up that fundamental question again, Bitcoin versus gold. Especially now, has the narrative shifted?
It's definitely reignited the debate. Investor Anthony Pompliano, for example, has been quite vocal about this recently.
What's his take? Is Bitcoin replacing gold?
Not exactly replacing its history, but maybe its function going forward. Pompliano acknowledges gold's long track record, its physical scarcity, its universal acceptance as a store of value. No one denies that. But he argues Bitcoin will continue to be a better store of value on a relative basis. That's the key. Relative performance.
And the recent numbers back that up.
Dramatically. Gold's done well this year, up maybe 15%, driven by all the uncertainty we've talked about. But Bitcoin, it's basically doubled in the same time frame.
That's a huge difference.
Right. And Pompliano sees this not just as a temporary thing, but as part of a structural shift. A move towards a digital store of value, especially when you have persistent global inflation and governments racking up massive debt.
Let's talk scarcity. Gold is physically scarce, hard to mine. Bitcoin is digitally scarce, programmed. Which is better?
The argument for Bitcoin focuses on efficiency and transparency. Its scarcity is algorithmic, fixed at 21 million coins, totally predictable, verifiable by anyone. You have events like the halving, the next one in 2024, that automatically cut new supply.
Whereas gold supply depends on mining success, costs.
Exactly, less predictable. Pompliano would argue Bitcoin's programmed transparent scarcity is just fundamentally more efficient and suited for a digital world, easier to verify, easier to move.
So this isn't just an academic debate, it's strategic for investors.
Absolutely. It boils down to a practical question. In a world with runaway inflation and record debt, which asset is going to do a better job of protecting your purchasing power over the long term?
Gold offers history and stability.
While Bitcoin, proponents argue, offers not just protection, but also potentially significant growth as it continues to be adopted as this new digital reserve asset. It's framed as gold preserves, Bitcoin potentially preserves and grows in this specific economic climate. #TagTagCheckYesX. Conclusion and mandatory outro.
Wow. Okay, we have covered a lot today. Let's try to quickly recap the key takeaways from this deep dive. Globally, we saw a major political shift in Bolivia, with Rodrigo Paz ending a long left-wing cycle.
And that significant U.S. policy change from President Donald Trump cutting aid to Colombia, citing drug concerns, big regional implications there.
In El Salvador, a mixed bag. Security gains like the homicide-free weekend and huge financial confidence with credit over $20 billion.
But shadowed by really serious issues. The alarming 45% rise in hospital infection deaths at Seguro Social, the concerns about superbugs, and those heartbreaking reports of missing deportees and deaths post-release, like Professor Manuel Mira.
And then the markets. Bitcoin rallied strongly above 111K to start the week. Eyes are now on those potential short squeeze targets up at 116K, 117K.
But that bullishness is fighting against significant headwinds. Low volume, bearish divergence warnings from Roman, and especially that $102,000 wick that still needs filling, psychologically at least. Plus, institutional capital showed caution, pulling money from BTC ETPs, even while making leveraged bets on ETH.
And it all seems to hinge on this week's macro data, doesn't it?
Absolutely. That unusual Friday CPI release, happening despite the U.S. government shutdown, is critical. The market expects a rate cut from the Fed next week.
Which brings us to our final thought for you, the listener, to chew on this week. We know the market expects that Fed rate cut. It seems priced in, but what if? What if that CPI number on Friday comes in unexpectedly hot?
Right. What if inflation surprises to the upside, forcing the Fed to maybe pull off on the cut or even sound hawkish?
How would that sudden shift in monetary policy expectations impact everything we just discussed, particularly that Bitcoin versus gold debate? Would we see a flight back to the perceived safety of gold, or would Bitcoin's digital narrative hold strong even then?
Something definitely worth watching as the data drops.
Indeed. Okay, before we sign off, one last reminder.
Your support is truly what keeps this going. Please consider collaborating or donating via PayPal or the Bitcoin QR code. All the details are in the description.
And if you're interested in advertising your product or service to our audience, reach out via the email provided. That support is vital for the continuity and quality of these deep dives.
Thank you for joining us and digging deep into these topics.
Until next time, farewell.